This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
We go to a story that is the most read on the Bloomberg, or among the most read all day today.
Yeah, broke after the close yesterday. It raises the question, is Jamie Dimon possibly setting up to really, finally, could it be, actually say goodbye, Carol?
I don't know. It looks like it. The actual news, by the way, JPMorgan Chase, Jamie Dimon, of course, the CEO there, moved some of his top lieutenants into new senior roles, positioning them for more experience running the firm's operations as he prepares potential successors. That's how we reported it out. It does look like he's giving people some more experience or bigger experiences, if you will. So what does it mean? Bloomberg News senior finance reporter Shri Natarajan is here in our radio studio. Shri, what does it mean? 2.5 years left. Is he kind of getting ready?
Let's be clear, that 2.5 years is just the 5-year retention package he got. That doesn't necessarily put an end line for the Jamie Dimon tenure at JPMorgan Chase. Look, it is the latest edition of the musical chairs at JPMorgan, where Jamie Dimon is conducting this move. We've seen this before, we're seeing it again, and the thing is, any organizational reshuffle that we see now, this many years into Dimon's tenure atop the country's largest bank, the most profitable bank, obviously begs the question as to what are the tea leaves we can read from it about succession. Who is best placed? So actually, just let's look at
Let's read some tea leaves.
Let's look at the names here. Here you have, till yesterday, people would have argued Jen Piepzak and Marianne Lake are the two executives who've seemed best positioned to be the successor to Jamie Dimon. So what does this shuffle do? You're taking Jen Piepzak from the consumer and community banking side of it, one of the largest parts of this giant bank with a $4 trillion balance sheet, and moving her to the commercial and investment bank side, alongside Troy Rohrberg, who's the trading head, who now gets expanded responsibilities and by virtue of this promotion gets added into the mix of potential successors in a serious way. You have Marianne Lake, who's getting expanded responsibilities in the consumer and community bank side, and Chase still is the big beast, big component of JPMorgan Chase. My read of it, you have three contenders. Jen Piepzak gets to now have run all the important parts of JP Morgan. So I would put her a hair ahead of Marianne Lake, who's still a very solid contender, but Troy Rohrberg now suddenly leaps into the mix as a long shot contender. But it all ultimately depends on how much more time Jamie Dimon wants to spend holding the reins at JP Morgan Chase.
I just got to say, I'm just loving that there are two women who are strong contenders potentially to take over for Jamie Dimon at JP Morgan. Is that something that has certainly been important to him in terms of the role of advancing women at that firm, and then maybe, getting ready to set somebody to lead it?
I'm sure he would say it's been important to him. I'm also sure that he'd probably say that at the end of the day, the successor that he picks or he helps the board pick or the board decides is not going to be decided based on whether it's a woman or not. He's had two contenders in the mix. A few years ago, the move would have been extremely symbolic and valuable, but the fact that Jane Fraser became CEO at Citigroup sort of stole the thunder from JP Morgan. For the longest time, we always thought that maybe 12, 13, 14 years into Jamie Dimon's tenure, when he's ready to hand over the reins, it would be a woman running the country's largest bank. But Jamie's still there. And Jane Fraser's now the CEO of Citigroup.
And that's what I wanted to talk about. Jamie's still there. He has at least 2.5 years left on this portion. What do we know about? It seems like he has a lot of fun doing this. It really does. I mean, he's been doing this since 2005.
He seems to be having more fun than ever before. He still has a spring in his step. He's still ready to be the sort of the dean of Wall Street CEOs, the speaker of the caucus, if you may. He's representing the industry in DC. He's speaking his mind. Look, that's been true of Jamie Dimon forever, but more so now than ever before. And the stock's been up 25% in the last year. That's called winning, and that does not make anyone feel bored or tired.
So 2005, he became president and CEO. So would 2025 be a nice round number to come off of this position?
If you could read into his mind, sure, that sounds like a nice round number. yes, he's closer to the end of his tenure than not, but at the same time, he's playing his cards very close
I don't know.
to
You
his
could
chest.
argue that 2030 also sounds like a good round number to
And
come
another
up with, right?
2050.
What about the bill? What about when have they moved into the new building? Forgive me if I don't know that.
No,
No,
it's
it's
not-
still
it's not
very
So
so
much
when
under
is that
construction.
done? When is that done?
That's the other favorite parlor game. At least I've had a bet
Yeah.
with at least some JPMorgan executives, and I said a good time to call time on his time at. Wow, I said time 4 times in 6 words.
It's okay.
But a good time to call time on his tenure at JP Morgan would be when the new building's completed. Call it the Jamie Dimon building and say goodbye. But I have been definitively told that if I were to make that bet, I would lose it.
Shri, 20 seconds left. Is there anything else we need to know about the people moves announced yesterday? Because it wasn't just these 3 individuals you named.
There were other moves beneath that top layer, but the most important news for all of us is it clearly puts the spotlight on these 3 individuals. And when we think about succession and when we think about who will run the country's most profitable bank, it's these 3 names we have to look at right now.
Really fascinating, and it certainly popped when the news crossed yesterday. Shri, always making sense of the comings and goings on Wall Street. Thank you so much. Really appreciate it. That is, of course, Bloomberg News senior finance reporter Shri Natarajan here in our studio at Bloomberg headquarters. Shares of JP Morgan, by the way, they're up about 1.4% so far this year, just down a little bit in this trade. You are listening and watching Bloomberg Businessweek. Carol Massar, Tim Stenovec. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, real estate continues to be on our radar. Yesterday, you might recall, we got a great check on commercial real estate. We talked with Michael Levy. He's the CEO of Crow Holdings. What he talked about, Tim, was top-tier office. Not a problem. In fact, he's still building office space in places such as Dallas.
I know. I pushed back on it. He said it's got to be top tier.
Yeah.
I mean, they're building
Second, third, not so much.
Yeah, it's struggling right now. So we wondered, too, about the hospitality side of the business. The Bloomberg REIT Hotels Index has rallied 26% since late October. And we got the perfect guest with us. Kevin Davis is CEO of America's Hotel and Hospitality at JLL, Jones Lang LaSalle. It's the publicly held real estate and investment management consultancy. It trades under the ticker JLL. Kevin's here in our studio at Bloomberg headquarters in New York. Good to have you with us this afternoon. Welcome back.
Great to be here.
You know, our Bloomberg Pursuits team called it already. They said 2024 is going to be a record-setting year when it comes to travel on the tourism side, on the business travel side. First up, though, at JLL, you're involved in office, industrial, retail. Give us size and scope here when it comes to the hotel and hospitality business that you're in charge of.
Yeah, so our business relative to some of the other asset classes is relatively small, but certainly our impact on GDP is relatively large given the number of people that work in hotels and hospitality and leisure around the country. So I'd say it's a business that has a pretty significant impact on the economy.
Yeah, absolutely. And you guys obviously want to get into it because why? And you assume you can grow it to how much of your business?
Look, we have aggressive and ambitious growth goals, and so our hope is that we continue to move the business forward and make significant strides in terms of growth.
I mean, is it going to grow
Hospitality.
faster? Is it going to grow faster than office, industrial, and retail?
You know, it's hard to say. Certainly some of those sectors have been challenged and are in the midst of recovering. I will tell you one of the things that we're super optimistic about as it relates to hospitality. It has proven to be a strong inflation hedge, and while inflation looks like it's in the rearview mirror, as a result of that, it's attracted a lot of institutional investors into the space. And also hospitality typically offers incremental yield relative to other asset classes, and so as a result of that, investors are coming into the space.
Kevin, you talk about investor interest. Quantify that. Give us an idea of how it was maybe pre-pandemic. I mean, tell us because how long have you guys been building up this business?
I mean, we've been in the hospitality business at JLL for over 25 years.
Okay.
So this is a core business for us, and we are leaders in the space. So just by order of magnitude, and I'll give you global numbers. I mean, generally, globally, hospitality, it's typically between $75 and $100 billion worth of transactions that take place in a given year. Last year, globally, we had about $50 billion worth of transactions. So we were down about 30% relative to 2022. But we expect that it will likely increase, sales volume, transaction volume will likely increase 15 to 25% this year. So we are on the way back. We don't expect to get all the way back this year, but we think we're on a great trajectory toward stronger transactions activity.
What's fueling that? You talk about investor demand. Is it because we're expecting a lower rate environment? Is it because you expect the economy? And I'm curious, when you look at the economies, I'm assuming it's the U.S. and elsewhere, or is it the U.S. specifically?
Yeah, it's strong growth in the U.S., strong growth in Europe. Globally, though, relatively speaking, we actually expect more growth in Asia, which has been slow to emerge out of the pandemic.
Japan?
Japan has actually started, but more specifically China, which has recently opened up much more. So we expect that you'll see strong growth in China. Also, inbound travel from China to the U.S., which is something that certainly it's not close to recovering to what it was pre-pandemic.
Hey, talk a little more about that, because we've talked a lot on our program about the struggles that China faces internally, the struggles that they face with their own property market, with the economy, with youth unemployment, with demographic challenges. Why are you bullish on China?
Well, I'm bullish relative to what we've seen over the past couple years. I'm bullish in terms of Chinese travelers getting out and traveling. I mean, you ultimately have an emerging and growing middle class in China. And as the middle class grows, we expect that more people will travel, and will travel specifically to the U.S. And to Europe as well.
So what type of hospitality properties do you think investors are investors kind of clamoring for or asking for of you guys?
Absolutely. It's really the two poles, if you will. It's luxury, which has performed exceptionally well coming out of the pandemic, and it's select service and extended stay assets, which have also performed well.
What's select service?
Select service, so typically you don't have extensive food and beverage. It's primarily rooms.
Okay.
And you typically don't have a lot of meeting space. So you wouldn't, if you're going to a big conference, you're generally not, the meetings are not going to be at a select service hotel. You'll typically go to a full service hotel that has meeting space and banquets and catering, et cetera. Part of the reason why the select service space has grown, though, particularly extended stay, is people have a lot more flexibility now post-COVID as it relates to work. And you've seen a bit of the blended business and leisure travel, the so-called bleisure travel. And so because people have a lot more flexibility to travel when they are frequently on the road, they want a bit more home-like amenities. So extended stay, which typically have kitchens, are attractive. And that's a sector where we expect to see a lot of growth.
What about regional differences here in the U.S.? You talked about where you're seeing action globally, but what about here in the U.S.?
Yeah, so in the U.S., it's interesting, and it's changing. In the first couple of years out of COVID, we saw strong growth in the Sun Belt and the resort markets, which we expect to continue. We saw a meaningful contraction in the urban markets, New York, Boston, Chicago, Los Angeles, San Francisco. But the trend that we started to notice last year, which picked up steam and we expect will continue over the course of this year, is really improving performance in urban markets. So again, the New Yorks, the Bostons, Chicago, et cetera. The reason, there's really threefold. You've had return of leisure travelers. For many years, people were concerned to go to an urban city, to an urban market because of the pandemic. So you've had leisure come back. You've also had group travel come back. So people coming to the cities for meetings. And then you've also had a sector called business transient, which are business people coming to meet with clients and colleagues, et cetera. So that segment is all coming back. The other part, the last component though, is the global, which is early days of coming back, but we expect that that will pick up in earnest, and that's going to drive performance in markets like New York, Boston, San Francisco.
So go move a little bit more on San Francisco, because I feel like, Tim, we've had some different guests who are, it's fine, it's coming back. Others
say, no way, we're not touching it.
And that they make it so hard to build or do anything in that city. So you see opportunities there.
Look, San Francisco is a gateway market. It's a top 5 market. It's not going anywhere. Certainly it's having its challenges now. There are political issues, social issues, et cetera. But we certainly believe that longer term, San Francisco is going to be a great place to invest. And so, yes, the market is challenged today, but we think this is a short, medium-term issue, which over time San Francisco will recover.
You sound really optimistic.
I am
Bottom
optimistic.
line. So what's the risk out there? I mean, we have spent so much of January, laying out quite a long list of risks for folks out there, whether it's geopolitical, politics here in the U.S., and elsewhere. What if the Fed gets it wrong? Just got about 30 seconds. What's your number one risk that could kind of upend this optimism?
Number one risk is if the Fed doesn't cut rates as aggressively as the market expects.
So 6, 5 you want?
Or
what?
look, I think it's at least 3.
Okay.
Or if the rate cuts get pushed to later in the year. I think if one or both of those things happen, that will take some, not all, some of the optimism out of the market, and we may be on a slightly different trajectory, but ultimately we feel very good about 2024.
All right, well, this was a fun checkup. Thank you so much. Have a
Thank
great
you.
weekend.
I appreciate it.
Kevin Davis, he's Chief Executive Officer of America's Hotels and Hospitality over at Jones Lang LaSalle, joining us here in our studio at Bloomberg headquarters. All right, folks, you are listening and watching Bloomberg Businessweek. Carol Massar, Tim Stenovec. We're back in a moment.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
A working class hero is something to be.
And now to the cover story of the new issue of Bloomberg Businessweek, featuring none other than Shawn Fain, the president of the United Auto Workers, who earlier this week made quite a bit of news when the UAW endorsed Joe Biden's 2024 re-election bid. But Carol, that's not why we're talking about Shawn Fain today.
No, it isn't. We're talking about Shawn Fain because after making historic gains for auto workers last year, he's now got his sights set on a company we talked about a lot this week, Tesla.
Well, Josh Eidelson and Gabriella Coppola write all about Shawn Fain in the new issue of Businessweek Magazine, available on newsstands, on the Bloomberg terminal, and at bloomberg.com/businessweek. Josh Eidelson is Bloomberg News labor reporter. He joins us on Zoom from Washington, D.C. So, Josh, before we get to what exactly Fain is trying to do and the UAW are trying to do, it's not just Tesla, by the way. There are a lot of companies in the U.S. that are trying to organize beyond the big three. Talk a little bit about the wins that he had last year and how big of a deal it was that he was able to get those concessions for the UAW workers from the big three.
The contract victory that the UAW pulled off this fall has no precedent in the past several decades of the union's history. The union won raises that with cost of living increases will be a third over the next 4.5 years for many workers. Some workers will see their pay more than double if they were previously classified as temps. The union also won some key victories in areas like making it easier for workers at the joint ventures of General Motors and Stellantis to unionize, join the UAW, and join the existing union contract over the coming years. And so this was both a reversal of a trend where auto workers have been losing ground to inflation, and also a big step towards securing the union's future as the auto industry changes. But to continue to do that is going to take a lot more work and, in fact, climbing more difficult mountains for this union.
All right. It sounds like one of those mountains is named Tesla. So talk to us about, he set his sights on Tesla and what his goal, mission, and how he thinks about it.
So the union is trying to organize 13 companies' non-union plants to organize 150,000 workers, double the number of automaker employees that are in the UAW, a union that has lost the majority of its membership in the past several decades. Mm-hmm. And Tesla is one of those 13 companies. It's a particularly alluring and difficult target. It's the company that is synonymous for many people with EVs. It's the most valuable automaker in the world, but it's a company whose CEO, Elon Musk, has shown that he's staunchly anti-union and willing to put up with embarrassing media and lengthy legal battles in order to get what he wants. The U.S. National Labor Relations Board has found that Tesla repeatedly violated the law in response to prior UAW organizing, including by firing an activist who still has not gotten his job back, now 7 years later. Tesla has denied wrongdoing. Elon Musk has made clear that he would see unionization in the plant as a failure on the company's part.
So how then, why is it so difficult then for the UAW to organize? Because it's ultimately not up to Tesla as a company and not up to Elon Musk. Why is it so hard for the UAW to actually organize the folks who work at Tesla and get them on their side?
So under U.S. labor law, it is not easy to unionize a big company that is trying to stop workers from organizing. Companies have the ability to use tactics like mandatory anti-union meetings that labor board precedent says are legal. when there is retaliation, although it's illegal to punish someone for organizing, the labor board does not have the authority to hold executives liable or to make companies pay punitive damages. And as we've talked to people, there is a real sense among a number of Tesla employees that if they challenge the company, it could lead to punishment for them or even to shutting down the plant. There are, of course, other employees who don't see a reason to have the UAW. And over the years, the corruption scandals within the UAW have been one of the talking points for Elon Musk and other executives against the union. So Sean Fain has worked hard to distinguish himself from the union's recent past, and he's been quite a vocal critic of the direction that the union was going until he took over.
I kind of know the answer to this because I've read your story, but I mean, Tesla didn't respond, right? So they haven't weighed in on this, at least for you guys.
Correct. Tesla did not respond to inquiries.
So, you've been watching this movement, and, it's really fascinating in the auto industry because I do think, right, they have to be careful because you don't want to, it's a global EV race specifically, and you want to make sure that the U.S. automakers are winners as well, right? That they are part of this market going forward. How does he think about, being fair and making sure that the automakers here in the U.S. are still competitive globally? And just got about 25, 30 seconds.
Sean Fain has argued the U.S. should not be copying Chinese labor standards. There should not be a race to the bottom to try to match how cheap labor may be some other places. If anything, he's suggested to us, it's the fact that China has a strong industrial policy that the U.S. should learn from, and that trade policy has a role here. But also he's working to raise the floor by organizing the non-union companies, which of course would make it easier to continue to win more at the big three in the future so that the union is not an island in Detroit.
Well, we talk about themes to watch. We talk about AI. Definitely we're watching the new class of diet drugs, if you will, or weight loss drugs. And I feel like union organizations, too. This is The Cover. Josh Eidelson, thank you so much. He is Bloomberg News labor reporter.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, a gauge of pending U.S. existing home sales rebounded sharply in December to a 5-month high, suggesting the recent drop in mortgage rates is helping to stabilize the resale market. That recent drop, by the way, in mortgage rates also helping to bring sales of new homes in the U.S. past forecasts in December. We got that data yesterday. And in general, we've been thinking a lot about real estate and talking to different voices in different sectors of the industry.
Yeah, some sectors that we've covered in recent days have been office, hospitality, hotel, industrial. But it got us thinking more about so-called alternative real estate assets. We're talking about senior housing, self-storage, student housing, and more. It's top of mind at Harrison Street, a company that focuses exclusively on so-called alternative real assets. The company has $55 billion in assets under management with more than 500 institutional investors around the world.
Christopher Merrill is CEO of the Chicago-based Harrison Street. He's in town and he joins us here in our Bloomberg Interactive Broker studio. So great to have you here. We like to start big, broad. It's a new year. How are you looking at 2024 and how it compares to coming off of the pandemic and then even pre-pandemic?
Sure. Well, thank you for having me. It's great to be here.
Yeah.
We look at this year and we're absolutely excited about the alternative segments. To us, this is now sort of the second black swan event we've been through as a firm. We were the first mover in alternative real estate starting the business in 2005. So we saw how these alternative assets did in the global financial crisis, and then we saw how they performed in the pandemic. So coming out of this environment and going to 2024, what you have is a situation where demographics are solid, they're strong, but supply has been choked off. So many asset classes that you mentioned have a ton of headwinds. When you think about what's happening in student housing, senior housing, medical, life science, tremendous tailwinds right now as demand's increasing, enrollments are up at schools, aging population, and there's no supply. So we look at this as some of the greatest vintage years we're going to see for some time.
I understand that for life sciences, medical, senior housing, student housing, but self-storage, isn't there a glut?
It's interesting. Self-storage is a fantastic asset class, and it really is one that you have to look market by market. It's a sort of not in my backyard asset. But the great thing about storage is people use it in good and bad times. It's life events. It's
and also
marriage,
people
deaths.
never get rid of their
They
stuff.
don't ever get rid of
It's
it.
so
In fact, I
uniquely-
have a
Never
few of them.
seen storage
It's
war.
so uniquely
Exactly.
American.
But it's
But
amazing.
isn't there a glut of it? I mean, doesn't
Well,
it
I
drive
think
prices
what the
down?
way we do, how we invest in alternatives, because there's a lot of different ways to invest in
Yeah.
alternatives. We like to invest in asset by asset, create portfolios, and then sell to the larger players. So for us, there's a huge demand in owning these assets. It's consistent cash flow, month-to-month leases, so in an inflationary environment, you can really reprice. And so what we like to do is do the hard work, build portfolios, and then sell to those groups that are really trying to get exposure to the asset class.
Is it nice that self-storage also has 0 employees, so their overhead is so low?
It's amazing. It's the lowest default asset class. You get about the same rent per square foot as an apartment, but you really don't have a tenant. When someone leaves, you roll it up, you sweep it. So it's a great business, but the challenge with it is it's an easy asset class to build.
Yeah,
So you
that's
have
what
to
I'm
go into
saying.
markets where it's hard entitlements because it's not in my backyard. So you got to find high barrier to entry markets. Once you own those assets, fantastic.
What happened during the pandemic to all of those assets?
So what happened, it was fantastic, during the pandemic because at first people were nervous. What's going to happen to student housing? What is online learning? What's going to happen to your off-campus housing environment?
And self-storage particularly.
Yeah.
Right?
I mean, what happened with all these asset classes is
Curious.
just consistent. People that were doing businesses online were using storage facilities. People were, when you thought about people moving, there was more flexibility. So people were starting to move into other markets, right? You saw a lot of remote working. So people were traveling, moving. And so they were using storage.
And student housing, same thing?
Student housing was fantastic because really the students didn't want to be in mom or dad's basement. They wanted to stay in their off-campus apartments.
I saw it with nieces. My
And-
daughter wasn't in college yet, but my nieces didn't care if she was on college. I think it was her first year. She was a freshman.
Yep.
And I think after having to stay home for a little bit, was like, I think, very happy to be at least on campus. Had a whole dorm room to herself.
And that's what's happening. You look at the Power 5 universities, enrollments are up. You're seeing rent increases 8 to 10% a year. There's just no supply.
Talk to me about the type of student housing you do, because not all student housing is created equal. I know that the student housing that
It's
I
all
experience,
posh, Tim.
student housing that I experience isn't necessarily the same student housing that other folks have experienced. So.
It really is a different level of quality than a lot of us experience. But it's
That's
really
one way to
Is
put
that
it.
what you say?
well. I mean, it's what it is.
Does it come with a beer-soaked couch outside?
maybe-
a
maybe
beer-soaked
some.
couch outside. In the
I
driveway.
think that the key with the business is it's all bed bath parity. So it's like multifamily, but really what it is not bed bath parity. 3-bedroom, 3-bath, but it's a real focus on gated, well lit, safe. Safety's a big issue. So that's really a focus is creating an environment where you are providing safe environment, study rooms, amenities, health clubs, et cetera. So,
But are these student housing? Are these student houses that are multi-unit that are affiliated with a college or university?
So,
or are you essentially building like a huge building of apartments?
So
that
a
is
big
geared
part of
towards
our
students?
business, we're sort of the largest owner of off-campus housing. So that's not really affiliated with the university. It's
Right.
off-campus. But the school loves it because it becomes an amenity of the school. They can say to a student, when you're a sophomore, junior, senior, this is where you can live. So the schools like working with good managers. We also have a part of our business, what we call our P3 business, where we're doing public to private partnerships with universities where we're working with and helping them build dormitory because a lot of these big universities don't have the capital.
Yeah.
So we've probably got 30 to 35 universities that we are actually helping them with their housing.
Hey, security deposits in student housing.
Yes.
What's the average rate that you actually keep from those? Because these people just destroy the rooms, right?
You know what? It's fascinating that if you provide a nice high quality product and you walk the units on a regular basis and you have the willingness to kick children out if they're not taking care of it and you're billing the parents, actually they're taking very good care of the units. And we have a higher percentage of women a lot of times in these units. And so you're actually seeing it's not the type of thing. And that's when we started the business. It was student housing is an institutional asset class. It's Animal House. There's no way this is going to be institutional. But I think people have seen how the industry has really developed. And it's really become an asset class where insurance costs are lower than multifamily.
Right.
We have better rent growth in multifamily. And you have really sticky, strong demand drivers.
Well, and you have parents who are footing the bill.
and you have parents who are footing the bill. So from a credit standpoint, you think of owning a multifamily versus owning student housing. We have great credit.
Sticky, not because you spilled Jell-O shots everywhere.
I have to tell you, I go and
I hang out with you, Tim.
There's a story there. I've helped my daughter move out, and I am amazed at some of her roommates are like, yeah, we'll just leave that in the fridge. And I'm like, nope, you're cleaning it all out.
Yeah.
Everything's going to be clean because I want the security deposit back.
That's right.
I'm a tough cookie.
You're bringing me back, Carol. Senior housing.
So senior housing. We're just getting older.
People are getting older, but the challenge is, and there's different ways to invest in senior housing. Is
we're all getting older, but we also
we're having
want
memory issues, assisted dementia. So where we focus is on independent living, memory care, dementia, rental, and private pay.
Right.
We don't focus on skilled nursing. That's more public pay issues. But when you look at what's happening, 5 million people turning 80 by 2030. There is not near enough supply right now. So we're going to wake up in 4 and 5 years and wonder, where are we going to house all of the folks that have memory and health issues? It's almost impossible to take care of a loved one that has Alzheimer's dementia. So it is a very important asset class. It's hard. It's not easy. You need great operating partners. But it's a business that we're very bullish on, and we're seeing occupancies back to pre-pandemic levels right now.
How do you design for that, just in the last 30 seconds that we have?
I think what you do is we have folks that have been taking care of dementia and Alzheimer's payers for decades. So it's really about what paint colors you use. How do you do carpets? How do you do the right caregivers? And so really for us, it's about choosing great local partners to work with.
I've seen it firsthand, and there's safety issues, so somebody can't just walk out. There's a lot of safety measures in place. Favorite market right now? Geography, real quick.
I think right now we're active in U.S., Canada, and Europe, and so we love all those markets. So for us, if I'm near a great university or near a great hospital system, that's where we want to be. And so we can be really diversified across the U.S. and Europe. And so it's hard to pick a favorite market. We just love some of the fundamentals right now.
All right, can leave it there. Real fun. Thank you so much. Have a great trip back home to Chicago.
Thank you.
Christopher Merrill, he's the Chief Executive Officer at Harrison Street, joining us here in our Bloomberg Interactive Broker studio.
What was your student housing like in college?
I was here in New York City, so it's some old New York apartment buildings once I went off campus. But it was owned by the school.
Yeah.
Yeah. There were some roaches.
Okay, well, more stories to come.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, coming up on 18 minutes left in today's trading session, getting ready to wrap up the Friday trade here, wrap up the trading week, bouncing around a little bit on the equity side of things today. But our next guest says the market is trading in an erratic mode. So it's like you knew exactly the day
erratic,
it was going to be on. Exactly.
Erratic.
It's kind of what we got today a little bit.
Yeah, I think that's a fair characterization.
Let's get to it with Vance Howard. He's CEO at Howard Capital Management. He's on Zoom from Texas. Hey, Howard, it's so great to have you. Vance, rather, it's great to have you back with us. I think I've done that to you before. You got a name I could call you Vance or I could call you Howard and it would work. How are you?
I've been called worse.
You and me both. It's good to have you here. Happy New Year. It is kind of a bouncing around kind of day, certainly on the equity side of things. I think we get some cross currents when it comes to earnings, some cross currents when it comes to some of the economic data points. Talk to us a little bit about how you are seeing things, because a bunch of your mutual funds and your ETFs, they continue to really outperform. Tell us about the markets and what interesting trends you're seeing right now.
Well, our proprietary trend indicator, the HC on Byline's positive, so that's telling us that the trend is clearly up. And, when I wrote that little article about the markets being erratic, it's just some froth that needs to kind of come off the market. We had a great last quarter of 2023, and then the first 3 weeks going into 4 of 2024 has been really robust and positive. So to have a little modest pullback and some volatility is normal, and it's going to happen. And of course, Tesla dropping 12% didn't help anything either.
Okay, we'll get to Tesla in a second, but I want to know how the proprietary technology that you have is giving you a buy signal, even though you're seeing froth.
Well, even though you got an uptrending market, you're going to still have markets that want to pull back 2, 3, 4% and 5% or whatever the case may be. That's not going to change the trend. The trend's still going to be up, and all pullbacks as we see it right now, as long as the trend's up, are viable. So, any of this froth that wants to work its way off, and a little bit of sell-offs here and some stocks that are selling off more than others, you really need to take a look at those, because those are going to be some really great opportunities into 2024. I'm very bullish on 2024
because of the trends that you are seeing and your trend lines.
Yes. Yeah.
Does it ever go wrong?
Oh, absolutely. It's wrong 30% of the time, but it's usually right 70 also. So it has a good hit ratio. But, Carol, there's so much cash on the sidelines too. I mean, everybody's sitting on a mountain of cash in these 1 and 3 month treasuries. I mean, my goodness, if any of that money starts to come back into the market, you'll see it move higher.
Where do you think that money goes, though? Because Carol and I have had this debate over the past few months quite a bit.
Yeah.
Is that money going to go to fixed income, or is it going to go to equities? Because it's in cash right now for a reason. And that reason is that these money market funds are paying 5%, and you can still get fixed income around there.
Yeah, well, you can. And let's say you're getting 5% on a money market, but he drops rates. Now you're down to maybe 4.5 or 4, or 3 and 7, 3 and 7/8 or something. But if you think about that, if you're getting 2.5 or 3 on a dividend-paying stock with upside appreciation, all of a sudden that cash becomes a little less attractive, and dividend-paying stocks become more attractive. But the market's also broadening out, guys. One thing that we noticed in the last quarter of 2024 is how small caps started to finally move up. And when I say the trough, that was kind of the trough I was talking about, is because we did very well in the small caps. They ran up, and we're seeing a pullback, but that pullback's nothing more than technical and healthy. That's just a period of consolidation. So lots of opportunity out there this year.
So wait, what kind of consolidation, or what kind of move to the downside do we need to see to get some of the froth out of the market? And I'm assuming you're looking specifically at the S&P 500, or maybe you're looking at that as well as the NASDAQ.
Mainly looking at the NASDAQ.
Okay.
The S&P 500 has been trading, quite well. But, when you take certain sectors like the small caps, because of the massive run-up they had in the last quarter of last year and a couple of weeks in the beginning of this year, some of this pullback in small caps are needed and warranted. They just can't go straight up. They've got to sawtooth their way up. So this is a viable opportunity in small caps. And, we saw an explosive rally in the semiconductor index. And, when you have that big of an explosive rally, there's going to be a pullback as people are going to start to take profits. And that's kind of what we mean by froth here, is some of these sectors that have really done really well, they're due for a pullback, and they're viable pullbacks too.
Okay, let's talk Tesla now, because we are just under a month into the start of the year, and already Tesla has lost 26.5% just this year. What are your thoughts on Tesla?
Fortunately, and I'm very grateful, we didn't own any Tesla going into that sell-off. So, so that's great. So we got a lot of cash to work with. It's going to be a great stock to buy down here. And the way to trade this stock, guys, is you're going to see it run up a little bit, and then it'll come back and retest the lows. Then you know that the bottom's pretty much set on Tesla. But it's a great company. I mean, the thing is it's really a wonderful company. And if they start selling cars at 25,000 or 26,000, which they're talking about doing later this year and into next, you'll see a lot of revenue flow back into Tesla. But for a long-term trader or investor, Tesla, I think, is just an outstanding play.
Why do you like it so much? Why do you think it's such a great company?
Well, you talked about selling lower priced cars. If and nuts were candy butts, we'd all have fun at Christmas, is what I like to say. But I mean, that has been kind of the goal, and they've cut prices a lot, but that's impacted margins. So, I mean, you feel comfortable enough that they're going to get there.
Oh, I do. And, don't ever bet against Elon Musk. I mean, some people hate him, some people love him, but boy, I sure would hate to bet against the guy, because he's a true innovator, and the guy's young and still got a lot of energy. So there's a lot that he can do with a company like Tesla.
You don't think he's distracted by Twitter? You don't worry about him being distracted by something like our X?
That guy is always going to be distracted by something. That's just the way his mind works. But when he stays focused on something, it usually comes out to be a very, very good outcome. And he'll be back into Tesla. He hasn't quit running Tesla. He's still all in. I was reading the other day that he'd like to own more of it. But you can't short Elon Musk. I just wouldn't do it.
Okay, what about Salesforce?
Up 6% this year. We just got news that they're going to cut some more workers. They're going to cut about 700 workers, and this is on top of what a year ago they cut their headcount by about 10%.
Mm-hmm. I love that. I love companies that have recurring revenue, Carol, because this one is great. I mean, they've got a monthly subscription base, so they have recurring revenue coming in each and every month. They don't have to sell a new product every month to keep their head above water. And a lot of what they're doing financially is they're becoming more profitable by reducing overhead because they've had a lot of activist investors that are really sniffing around and sort of getting on top of them. And so this reduction in sales in their sales force, I think, is warranted, needed. I think that was Throff they could get rid of. So I think Salesforce, from a technical standpoint and from a financial standpoint, I think it looks really attractive this year.
So it's interesting. And then your other things that you like is something you've talked about, the small cap or the small, growth area, as well as the Russell. You think that the small cap is an area of the market that you think investors have to continue to focus on and plow new money into. Just got about 30 seconds.
I do. I think you buy that on a pullback, and I think it's pulled back now. Like if you're looking at VBK, you're looking at the Russell 2000, either one, it's pulled back now, or it's a viable opportunity. And as the market spreads out, which it's going to this year, you're going to see other areas like small and mid cap start to move higher and start to regain some traction and look a lot more attractive going into 2024.
Vance, real quickly, 15 seconds. Do you care what the Fed does next week?
Absolutely, I do. And I don't think they're going to do anything that's going to surprise anybody, but yeah, I'm watching the Fed very closely like everybody else.
All right, we're going to leave it there. Always get so much. You pack it in, and so appreciate it. That's Vance Howard, of course. He is CEO at Howard Capital Management, joining us on Zoom from Texas. Just got a few minutes left in the trade, folks, and we've got the S&P down about 4 points, the Dow up about 52, and the NASDAQ down just about 60. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.